All right, so those are stocks which we will get to in just a bit from now. Jahangir Aziz is head of emerging markets, economics research and commodities at JPMorgan, and Rupal Agarwal is senior research analyst, Asia Quantitative Strategy at Bernstein. Guys, thanks very much for joining in. Good morning. Great to have you with us here on the program. Jahangir, we've again kind of seen a bit of a regime change in terms of how markets approach data. Good was good, now good's become bad. A string of good data and markets are sulking. What do you make of it, and what next, according to you?
Look, I mean, most of the reason as to why the market is reacting the way it is because, if you go back to October, November of last year, recession fear, and also which was combined with that, core U.S. prices were going down, inflation was going down. All of that combined to actually ease monetary and financial conditions significantly during that period of time. The 30-year mortgage rate fell almost 90 basis points, the 10-year slipped about 75 basis points. The dollar eased, and the equity market, recovered quite strongly. And I think that easing of financial conditions was clearly not the way in which the Fed was looking at things. And I think that after discounting the Fed for a very long period of time, I think the January CPI number and then the revision of core inflation up from 3% run rate of the last 3 months to 4.5% run rate, and then the string of very strong employment numbers along with ISM numbers, PMI numbers, etc., suggested that the market was probably had moved too far away from the Fed. And over the last 2-3 weeks, we are seeing the market gravitate towards the Fed. So I really don't think that good is bad and bad is good. I think that's been the norm for quite a while, Prashant. So that's not something new. But I think that market is finally tightening towards the Fed after discounting it for a long period of time.
Okay, retightening. I like that. Rupal Agarwal is also with us. Rupal, what do you see as the end game of this Fed tightening cycle? Do you think the Fed can avoid a recession, achieve a soft landing for the economy that sees perhaps growth slowing considerably but not contracting?
So I think, the way that the data has started emerging, it seems like it looks as of now more of a soft landing than a hard landing. And that is exactly how the markets had been reacting, to all the very, very strong data that we've seen from the job market. In fact, even the consensus broadly does expect more of a soft landing than a hard landing. And that's actually one of the reasons why we think that it's better to actually rely on the market rally and be more risk on in the shorter term before we see hard evidence emerging of this becoming more of a deeper recession than what the markets are pricing in. So we do think that there are risks out there. One needs to be more cautious around them. But in the shorter term, because of the fact that inflation has largely peaked, yes, rates are likely to remain higher for a much longer period of time. One needs to be more cautiously optimistic. But I think in the shorter term, there will be, again, somewhat of a hope rally that we can expect.
All right. Hi, Rupal. Good morning. Rupal, you've mentioned in the past, I think, that China, Taiwan, Korea, they are preferences from the Asian markets, while India, because of these valuations, well, you're a little bit cautious out here. We've seen some correction, 1,000-point correction on the Nifty. What valuations do you believe that the Nifty could start bottoming out? Because still earnings are elevated. We still need to see earnings pullbacks. And maybe, in fact, that 1,000 rupees on the Nifty EPS, maybe that's not coming in the near term. Go ahead.
Yeah, so I do agree that, valuations, the way that they were looking too stretched at the beginning of the year, we've definitely come down quite a bit. We are now back to 1 standard deviation above the longer term mean, which is clearly better than, say, when we started at around 1.8. But relative to all the other markets, India is still, the most expensive to its own history, and relative to, say, emerging markets. So we are still quite expensive. And also, the point that you made, we do think that the earnings downgrade cycle is going to accelerate from here. and hence, valuations at this point don't look justified. The other interesting aspect is that investors are actually now demanding higher equity risk premium, which was not the case for the last 3 years. And in the light of, the yields still remaining higher, and even though the pace of tightening has moderated, within India as well, we're still looking for rate hike cycle to continue, which means that, in that context of higher yields, we don't think the current valuations, again, are justified. In fact, if we go back and look at historical trends, at 7.3, 7.4% 10-year bond yields in India, markets should have been trading somewhere around 18.5. We're not yet there. So I would say the rate hike cycle that we've already seen has not been priced in, and there's more to come. And hence, valuations in this entire light doesn't look sustainable.
1.5 is the PE multiple, right?
Yes. Talking
So,
about
and
the
currently
PE
currently we're closer to around 20.
Currently, we are closer to around 20, yes.
So just extrapolating that, maybe in fact, it opens up a downside of close to around 10% or, odd from these levels as well.
Absolutely. And in fact, I would say that even from a sentiment perspective, that 10% drop could be a big positive for a lot of foreign investors to come back to India. That has definitely come up in some of the recent conversations that we've had with investors, that something in that range could actually make them come back, and take some more exposure in India.
Jahangir, so in terms of the where we are, right? Is this a slight pause in sort of disinflation that we are seeing globally? Will one weaker, softer data do it once again to swing everybody on the other side? Well, all is well and good, or you think these expectations that it's going to be hard, inflation is going to be hard to beat? That's the feeling, expectation, which is getting entrenched now. What's your sense?
So I think, you are going to get surprised by the strength of the core inflation. I think people are not the entire expectation was that headline inflation would come down, and that was because of the massive spike in food and energy prices during the same period of time last year. And I think you need to wait for that to happen. Most of the spike took place after the beginning of the Ukraine war. So that would be March and April. So you need to have patience enough to wait for March and April to come. And I think you will see the very large disinflation taking place. But core inflation was going to remain tight. That was always on the cards. And what you're seeing is that core inflation is surprisingly the upside. And that perhaps is where the market is getting pushed back, at least core inflation in the US and also in India. But I think that the big disinflation, you still have to be patient and wait for that to happen. But I don't think that the market is going to, at least by market meaning the US market, is going to get swayed by large disinflation in emerging market countries. It needs to see that happening in the US, and that looks much more difficult today than, let's say, a few months back. But I think that the Fed was very, very calm in the last 3 months of last year, when recession fears were skyrocketing and core inflation was coming down. And I think that they're going to be also calm by looking at the January numbers, etc. And I think that the fact that the market is now re-tightening towards the Fed, I think will give them solace. So we do expect the Fed to remain on this 25 basis points hiking for the next two FOMCs.
Okay, Jahangir, a very quick question, if we can wrap up in a minute. Did you take a look at the minutes of the MPC meeting? Because that indicated as well that the committee believes that it's not a time to pause even here in terms of rate hikes.
Sure.
If that is the case, then do you see it hit growth and demand? Because, inflation is definitely pinching pockets.
No, that is not true. If you look at the big parts of U.S. inflation, the one that is surprising you is non-rental services. That's the one that's going up. But compare gas prices 6 months back and today, I think what is actually driving the economy is the fact that you still have about a significant amount of household savings rate. and you're getting a relief from gas prices going down and headline inflation coming down from the 10s to the 6s, and that's keeping consumption up. So I think it is going to be very difficult to see how, unless you keep on raising rates and keeping it high for a long period of time, how this economy slows down.
All right, we'll leave it at that. We've actually run out of time, but not out of questions. Thanks a lot for joining us. Rupal and Jahangir, appreciate your thoughts. We'll slip into a quick break, but plenty of stocks to focus on when we come back. Our entire research team will be joining in.